is gradual. Sometimes it compounds with purpose, and in the right conditions, it becomes exponential. For First Capital, this was that kind of year. In 2024-25, First Capital continued its steady momentum, deepening investor relationships, expanding reach, and further simplifying access to investments. Our growth and efforts were recognized across the industry as leaders, from being named Brand of the Year to winning 24 national and international accolades, underscoring our relentless pursuit of excellence and innovation in Sri Lanka's capital markets. Our numbers tell the story of a company not just growing, performing with precision. 5 billion rupees in profit, 9.8 billion rupees in total equity, a return on equity of 58.97%, and a dividend payout ratio of 64.74%, directly returning value to our shareholders. Every number pointing to exponential value created, returned, and reinvested. This is our fourth year of integrated reporting, an approach that reflects how we create sustainable value across financial and non-financial dimensions. Capital by capital, outcome by outcome, all aligned with long-term impact. Our financial capital remains strong, with disciplined returns and bold reinvestment, driving consistent outperformance. With 5 physical branches and 1 virtual, and over 52% of clients digitally active, we're blending scale with efficiency. A digital adoption rate that continues to grow in step with client expectations. From an A+ stable credit rating to launching First Capital Invest, Sri Lanka's first WhatsApp investment platform for unit trust funds, we continue to innovate with purpose. We even launched a missed call balance inquiry service to help clients stay informed instantly. Our people remain our power. With a 52 to 48 gender balance, an 87% Great Place to Work score, and over 15 million rupees invested in training, we're shaping a future-ready, inclusive workforce. We made investments more human through conversations, education, and shared action. Our university program, Invested, has now educated over 1,775 students. With initiatives to building financial literacy in Sri Lanka, we achieved a digital reach exceeding 1.6 million, ensuring that a new generation of investors is growing with us. We're proud to back ambition on the field, in the classroom, and in the community. From the 2024 Asia Rugby Division 1 Quadrangular Tournament to the CSE Capital Market Quiz and CSE Masterminds and Varsity Battles 2024. As education partner for Room to Read and platinum sponsors of CRNFC 2024-25, the Monthly Medal Golf Classics 2025, and the Sailing Nationals 2025. We remain committed to nation building through opportunity. Environmental impact matters, and we've been taking responsibility, planting mangroves and coastal coconut trees, offsetting 309.9 tons of CO2e and driving active recycling initiatives. Our leadership continues to define the market. From equity research to fintech innovation, from treasury operations to primary dealership, First Capital leads across the board. Exponential isn't just about numbers, it's about mindset. At First Capital, we believe in the power of access, in simplifying the complex and building a more inclusive financial future. This was a year of acceleration, and it's only just the beginning. At First Capital, we believe access should be equal, so this year's financials are also available in Sinhala and Tamil, making investing more inclusive for every Sri Lankan. Our story is built on the belief that progress is most meaningful when it's shared. Every step forward is powered by the trust of our people, the strength of our partnerships, and the responsibility we carry for our planet. Together, we're shaping a future we can all belong to, and this is only the beginning.
Good evening, ladies and gentlemen. I'm Vibha Jaisingha, and I will be your host this fine evening. On behalf of First Capital, it brings me great pleasure to welcome you all to the First Capital Investor Symposium 2026, where we come together to share insights, conversations, discussions, and our ideas regarding the ever-evolving economic and investment landscape in Sri Lanka. First Capital Holdings PLC is a listed full-service investment institution in Sri Lanka, operating as a primary dealer, corporate finance advisor, wealth manager, and stockbroker. Supported by the Janashakti Group, the company is driven by its performance-first ethos, with a strong focus on stability, competitive advantage, and customer experience. With over 4 decades of capital market expertise, First Capital has received numerous national and global recognition awards, including Slim Brand Excellence, winning Brand of the Year, and Gold for Service Brand of the Year in 2024, and Silver for Service Brand of the Year 2025. Super Brands Sri Lanka status and A+ credit rating from the LRA for both First Capital Holdings PLC and First Capital Treasuries PLC with a stable outlook. Before we proceed, of course, I would like to acknowledge the presence of the members of the Board of Directors, Managing Director, Group CEO of JXG, Mr. Ramesh Shafter, Managing Director, CEO of First Capital, Mr. Dilshan Veerasekara, as well as the Chief Executive Officers and Senior Management of the companies within the Janashakti Group who are all here with us today. We are truly honored by your presence, and we thank you for being here with us this evening. With that being said, ladies and gentlemen, we have an insightful program lined up for you this evening, where we will feature the economic outlook and investment strategies for the year 2026, followed by a panel discussion comprising of some of the most respected industry individuals in the country. Ladies and gentlemen, this is the First Capital Investor Symposium 2026.
Shaped by volatility, noise, and rapid change, clarity is the real advantage. Capital doesn't chase certainty, it responds to insight. Understanding the landscape, reading between cycles, knowing where markets are and where are they going. This is where research matters. At First Capital, decisions are never reactive. They are informed by deep analysis, tested against time, and shared for long-term value creation. This discipline is not new to us. It is the result of decades navigating markets, economic cycles, and moments that demanded conviction. Recognized across the industry, not for following trends, but for understanding them. Awards are outcomes. Thinking is the process, and this room understands that. Leaders, decision makers, those who shape what comes next, and every stakeholder beyond this room. This is not about predictions, it's about perspective. A deeper view of the investment landscape. What's shifting, what's emerging, and what truly matters. First Capital proudly welcomes you to First Capital Investor Symposium 2026.
And now, ladies and gentlemen, to formally welcome you this evening, it is my honor to invite Mr. Dilshan Veerasekara, Managing Director, CEO of First Capital Holdings PLC and the Deputy CEO of JXG, to deliver the welcome address.
Good evening, ladies and gentlemen, and a very, very warm welcome to all of you to this First Capital Investor Symposium 2026, which is in its 12th edition this year. This event has got bigger and better with each passing year, both in terms of numbers who are present here, as well as who have joined online, and a very warm welcome to all of them as well. I do apologize for starting a tad bit late. We ran about 10-15 minutes late, but hopefully we'll be able to catch up through the program. Just a few things to sort of say in terms of why we come out with a research outlook at the beginning of the year and publish it and make it available to everyone free of charge. Because we believe that part of our job is not just navigating the capital markets landscape, but also helping people understand how markets work and to share that insight with the greater audience, the general public, not just our clients only, so that investors can make informed decisions. And I think that then essentially helps the market to develop and improves financial literacy across the country. I'm extremely proud of our research team who have kept improving their game over the years, covering all aspects of research, and we are probably one of the few investment banks who actually do cover that. So we do cover macro. We are very specific with interest rate views. We also cover equity. And like I said, the broader macro variables in terms of also growth, but also certain sectors and how they will perform. And you'll see our predictions that the Manthani's team will sort of share with you over the next hour or so. I'm also very proud to say that the quality of research has got better. And if you look back and evaluate, I think we, over the last probably 3 or 4 years, have a close to 85% success rate in terms of our predictions. If you look at everything that we said, from growth to interest rate forecast to the exchange rate forecast or the reserve numbers, we are ballpark just there on that. I think the only thing maybe we didn't predict as well was the performance of the equity market, which has overshot our expectations last year. And 2025 was a year of growth, a year of consolidation for, I think, the entire country. It's sad that Ditwa came at the last moment and sort of, spoiled the party. But nevertheless, we are quite optimistic in terms of Sri Lanka's outlook for 2026. And we hope that the insights that are shared today will be useful for all of you in terms of making your investment decisions coming into the new year. Once the event is done, we would also be having a networking session with food and drinks, and I please invite all of you to remain and network. We have quite a few members of our staff who will be here, and if you need any clarity on the report, which will be shared, I think, at the end of the presentation through a QR code, so you can download the report. You can have your clarifications with any member of the team that from First Capital present here today. So have an enjoyable evening, an insightful evening, and thank you very much for being here.
Thank you very much, Mr. Veerasekara, for those warm welcome remarks. Ladies and gentlemen, it is now my pleasure to introduce the presenters for this evening, Mr. Ranjan Ranatunga, Ms. Shahana Kanagaratnam, and Ms. Akna Thenakone. Ranjan is the Assistant Vice President Research at First Capital Holdings with over 10 years of experience in capital markets. His career began at SoftLogic Stockbrokers, Colombo, and later moved to Moody's Analytics, where he gained valuable knowledge and experience working for both buy and sell side investment banks in Europe. His expertise lies in both equity and fixed income research. He's a degree holder from the Staffordshire University and an associate member of the Chartered Institute of Management Accountants. Up next, we have Akna, who is a senior research analyst at First Capital, working across fixed income and equity research. Her work focuses on macroeconomic analysis and financial markets, translating economic and policy developments into practical investment insights. She has experience in financial and econometric modeling, data analysis, and market strategy. She previously worked at Frontier Research, where she was involved in macroeconomic and sector analysis with an emphasis on banking and the NBFI sectors. She holds an honors degree in economics from the University of Colombo and has received recognition for research excellence at regional economic forums. Last but not least, we have Shahana, who is a Senior Assistant Manager Research at First Capital Holdings, bringing over 8 years of experience in capital markets and investment research. Prior to joining First Capital, she served as a Senior Research Analyst at the CTCLSA Holdings and as a Delivery Lead at Equity Knowledge Partners. She's an associate member of the Chartered Institute of Management Accountants and holds a master's degree in financial economics from the University of Colombo.
First Capital Research takes pride in our commitment to delivering high-quality, comprehensive research and analysis within the capital market and macroeconomic domains. What sets us apart is our ability to deliver detailed and timely analysis on both equity and fixed income investments and covering macroeconomic factors, making us one of the few research firms to do so in Sri Lanka. Our research philosophy revolves around our vision, ensuring that we consistently produce high-quality investment analysis using fundamental valuation techniques. At First Capital Research, we are dedicated to helping all Sri Lankans by keeping up with evolving global research standards to build wealth with confidence. Our focus lies in delivering accurate forecasts and insightful outlooks, empowering investors to make informed and smarter decisions. Through our detailed reports, we provide comprehensive predictions on key topics such as interest rates, exchange rates, bond and equity market trends, offering a solid base of information and future predictions for strategic decision-making. We also cater to a diverse spectrum, including essential reports such as daily market updates, quarterly earnings analysis for the companies, and our coverage, detailed corporate updates, sector reports, equity strategy, and comprehensive fixed income reports. This covers sophisticated aspects like company valuations, industry dynamics, projections, trends, and our informed recommendations. In recognition of our commitment to excellence, we are honored to have recently received the Silver Award for Best Equity Research Report at the CFA Capital Market Awards. Our award-winning research, noticed for its exceptional quality and depth, is also made freely accessible to the public, empowering informed financial decisions with a vision of improving the lives of all Sri Lankans through financial solutions. First Capital Research stands as a forward-focused research entity, making all publications freely available online to empower Sri Lankans with informed investment decisions. As one of the few research houses offering open access to expert insights, we remain driven to lead the Sri Lankan investment banking landscape, uplifting lives across the nation.
Good evening, ladies and gentlemen. I would like to once again welcome you all to First Capital Investor Symposium 2026. So the theme that we have picked this year relates to our stance that economic indicators may soften, which in turn may rekindle debt sustainability worries. So the underlying assumptions on this theme, as well as the broader narrative behind this, together with insights on how to tackle this reality as investors, will be presented by my colleagues Ranjan and Shahana. What I will take you through is First Capital's track record, which is a depiction of how accurate or inaccurate we have been in the forecast that we did for 2025. So this is the criteria that we use to assess accuracy. We have 5 levels: accurate, mostly accurate, partly accurate, and then we have the lowest 2 rungs, weak accuracy and inaccurate. So without further ado, let's move ahead and see how we have fared in our forecast for economic indicators. So we've looked at 6 key indicators here, out of which 2 we have forecasted accurately. That's tourist arrivals and foreign reserves, which we came very close to in forecasting. And then we have forecasted 3 indicators within the mostly accurate range. And I must also point out that worker remittances as well as private sector credit growth surpassed our forecast, even though we came quite close when we put forward our numbers. In terms of inflation, which we once again forecasted in a mostly accurate manner, I think where we deviated mostly from the actual numbers was during the first couple of months of 2025, where we saw a steeper than expected level of deflation. And as you can see, during the remainder of the year, our forecasts have been largely on par with the actual numbers. And then we have earnings from tourism, the only economic indicator that fell within the range of partly accurate. Even though we got the tourist arrivals number on par with the actual figure, how did this happen? So what happened predominantly last year was there was a sort of shift in the demography of the tourist pool that arrived in Sri Lanka, which plausibly led to per tourist spending inching down, which is why we have sort of consistently overestimated the earnings from tourism to be in line with the tourist arrival figures. Moving ahead, let's look at our fixed income outlook and how we have fared. So in January 2025, taking into account the macroeconomic fundamentals and the broader economic reality that prevailed, our stance was that bond yields would see some upward pressure starting from the middle of 2025. However, now we know that this did not hold true. Taking into account what happened towards the latter part of January and through February, we sat down and took another look at things. And we ended up tweaking this initial outlook where we pushed the expectation for upward pressure on yields to the very latter part of 2024. So now we know that this we forecasted accurately. However, what happened after March, predominantly in April, May, and June? We saw bond yields sort of consistently adjust downward. And this was also fueled by a rather surprising rate cut that came in May. So taking this reality into account, we once again tweaked our assumptions in July 2025. What we said at the time was that we expected bond yields to remain largely stable within the next 6 to 12 months. And as you can see, we were right, but only up to November. In December, a bit contrary to our initial view, what we saw was slight upward pressure on bond yields. So once again, this has warranted us to relook at the fundamentals and the forces behind this trend. And we once again tweaked our outlook, which I believe will be presented by Ranjan. Let's move ahead and see what our outlook for policy rates was. Once again, we managed to forecast it in an accurate manner. We expected policy rates, or the OPR, to remain stable or unchanged through 2025. This was true except for one instance in May, where the central bank introduced a policy rate cut of 25 basis points, which we can all agree that we did not see coming. Then we have bank rates, or the AWPR, that's the average weighted prime rate. We have forecasted it in a partly accurate manner. So at the beginning of 2025, the range we forecasted for the AWPR was one between 10% to 12%. So even though we expected the AWPR to hover within this elevated range, as demand and capacity to lend to the private sector kept sort of persistently accelerating, what happened on the other side was that we saw credit to the state shrink. On top of that, we also saw the OPR being cut by 25 basis points, which then led to the AWPR sort of consistently remaining below the initial threshold of 10 to 12% that we forecasted. Since then, in July, we tweaked our forecast, and the new forecast stood at 7.5 to 8.5%, which has largely been accurate. Moving ahead, we have the exchange rate. This we forecasted accurately. The range that we had for 2025 was largely between 305 to 310 rupees, and this was actually an expected depreciation. The forces behind this was the resumption of private vehicle importation, the external debt repayments that we had in the books for 2025, as well as the persistent and almost aggressive purchase of USD that the central bank conducted throughout 2025. So finally, I think as Dilshan also mentioned, we have our outlook for equity, which we once again got in a partly accurate manner. Our forecast for the ASPI for 2025 was 18,500, which the ASPI sort of overshot in July or August in 2025. So the main reasoning behind this as to why our forecast was lower than the actual figure that came through was because the interest rates as well as inflation remained consistently lower than our initial expectations, which drove the momentum in the equity market, and also the strong corporate earnings that came in, which in turn reinforced investor confidence, further falling and boosting the ASPI. So ladies and gentlemen, that brings us to the end of my section. Let me now invite Ranjan to take you through the next bit of our presentation. Thank you so much.
Hello everyone. So with Akna taking us through the track record, let's move on to the story. But before we move on to the story and the outlook for 2026, I want to share a quote with you, every one of you. The quote is from an American economist and a Nobel Prize winner, Joseph Stiglitz. What he says is, austerity is self-defeating. It weakens growth, and weak growth makes debt problems worse. These words from the economist correctly highlights the current Sri Lanka trajectory, where we are looking at a slow growth coming into this year. But before we move on there, let me tell you the progress that we have made so far. And Sri Lanka had made tremendous strides in this front. So, starting off from, we have seen inflation cooling down. And we have seen external pressures easing, and the investor confidence is slowly returning back. All these things we achieved is through fiscal discipline that we followed in 2025 and before. But however, going forward, we think that this is not going to be enough. We think that reforms is crucial. And to move forward, let me tell you this story now. So to start off with, we look at the political stability. So we had two elections in 2024, which were critical to Sri Lanka. One was the presidential election, followed by the parliament election. Both, we saw the governing party win the majority. And in 2025, we had the local government election, where the governing party again secured the majority seats. So through all this, what we have seen is clear political direction and consistent investor confidence that's driving the markets and the economy. Then we have seen consistent engagement to the international communities, which has been very positive as well. But something that we are still seeing in a slow movement is the policy reform, where we think that much can be done in the next few years. Considering all these factors, we have continued to maintain our stance on the political front at low risk. Now, with political front discussed, let's move on to the economic side. So on the economic side, we think and we maintain our view where we think the risk factor is at medium-low risk levels. Starting off with economic growth, as Akna also correctly mentioned, we expect GDP growth to be fair between 3 to 4% for 2025 and 2026. And this is somewhat of a bit of a slowdown coming into 2025, where we are expected to see a growth of around 5% for the full year. And why this growth is slowing down, let me highlight from here. So, with growth slowing down, one factor is considering is the private sector credit growth. So we all know that last year, Sri Lanka had a large private sector credit growth, where private sector credit growth grew by around 26%. While on the other side, we saw state sector credit coming down. But looking forward, we think that the coming year, we can see private sector credit moderating to about 18% levels. So a couple of factors are contributing to that. One thing is that we are expected to see AWPR slowly inching upwards. And on the other side, we will see the pent-up demand that we had for vehicles in the last year start to get slowed down. And this is also expected to add a bit of pressure to the private sector credit. But something is changing this year. That is the state credit side. So last year we saw a contraction of 3%. But this year, from the research front, we are expecting state credit to grow by around 2%. The main reason is because we think that with the impact that was created from the cyclone Ditwa, the damage that caused to the infrastructure, there needs to be some rebuilding that comes from the government side. So this rebuilding is going to come through private in terms of credit, and that's why we are expecting state credit to grow. But something to note here is that when you look at the past trend, what we have seen is that when debt to GDP crosses the 50% mark, we see pressure coming into the system. But something to note here is we are not seeing that pressure coming because of the fact that mainly we see private sector credit moderating in 2026. Moving forward, inflation is edging up slowly. But based on our forecast, it is not expected to reach the central bank target of 5%. On the other side, we have liquidity. So liquidity also expected to be constrained with a bit of asymmetric between the banking system. Then the third factor that is limiting growth is the reduction in growth in the private consumption. So we all are feeling right now the reduction in private consumption. So when you talk with the society, what we are feeling is that a lot of people has been burdened with taxes and their disposable incomes are coming down mainly because of the tax front. And now with the inflation going up, it is expected to further contract. And this is expected to put a bit of pressure on consumer front. And this is why we are expecting the GDP also to get impacted from this. Next, looking at the external front, we expect external front also to add a bit of pressure to the GDP, with imports starting to gather pace in the near term. And while on the other side, we are seeing exports also slow down. Coming back to imports, Imports is expected to pick up mainly because of the construction activities that is going to come after the impact that from Cyclone Ditwa. Because as you all know, construction sector relies a lot on imports. And with the rebuilding effort that's going on, we will see imports picking up. But from the other side, we have been dealt with multiple blows. That is, on the other side, we are seeing the export side also slowing down. That is partly coming off from the global slowdown that we will see. So combine all of this together, we may see the trade deficit also starting to slowly expand, and that is also putting up adverse pressure on the GDP. Although trade deficit is increasing, the current account is expected to stay afloat, and that is thanks to two main factors. One is remittances, the other one is the tourism. In terms of remittances, last year we had the highest growth in terms of remittances, and it was a record. And going forward, we expect remittance flow to increase further, but the growth is flowing is expected to slow down. And in terms of tourism, as Akna correctly mentioned, we are seeing a bit of a change in demographics, where previously we saw number 1 and 2 spots being China and Europe, who were like the big spenders. But now, India is still number 1, but the Russia is coming into the number 2 place, where we are seeing a bit of spending coming down. And in terms of demographics also, we are seeing a bit of change in the age mix also that is coming to Sri Lanka. So previously what we saw was that a lot of tourists are coming between the age of 30 to 40 who can spend a bit more. But now we are seeing that pattern change a bit, where mostly it's the 20s and 30s coming who are mostly into adventure and backpacking. So that's why we are seeing tourism earnings growing, but not growing at the optimum level. And something to note is that the record year we had for tourism earnings was 2018, and that target is expected to be only achieved in 2027 based on our forecast. So all these factors combined, we are expecting reserve accumulation to remain slow. So when I talk about reserves, for 2026, we are expecting 7.25 billion in terms of reserves, and for the following year, we are expecting 7.5. And you may ask why we are expecting such a slow growth figure when the IMF targets is at around 8 billion for next year. Mainly it's coming from 3 factors. One thing is we may see the rupee depreciating, adding a bit of pressure to ability for the central bank to purchase dollars. On the other side, we will see the trade deficit widening, and that can also put adverse pressure on central banks' dollar purchase operations. Then something coming up is also the debt repayment factor that is also creating adverse pressure on reserves. Then coming on to BOP is expected to weaken, as I mentioned. So coming off from the trade deficit to the slowness that we will see in the export side, everything is going to translate into BOP as well as the the debt repayments. And but something that keeping the BOP on positive levels is the inflows that I have highlighted on this side. So talking about BOP and talking about debt maturities, I think this is an interesting topic that we may have to look at in the coming months, years. So 2025, in terms of the local and the ISB debt maturities, was one of the lowest years, where Sri Lanka only had to pay about 1 trillion rupees in terms of local and ISB maturities. But stepping into 2026, the maturities are expected to gather pace. And as you can see here on the quarterly outstanding bond maturities, first quarter itself is adding a lot of pressure on the operations. Then in terms of the ISB payments are more or less stable, where we had to pay about $336 million for 2026, and it's due in March. Then let's look at the fiscal side of things. So we'll look at the GDP and how things are going to get affected. And now moving on to fiscal, we think that fiscal discipline will continue moving forward. But there's going to be a challenge this year. That is gathering up the revenue from compared to last year. So all of you know that last year Sri Lanka generated about 900 billion rupees from vehicle taxes. So now with the pent-up demand slowing down, it is going to be difficult to gather up that revenue and fill up that hole. But something is there that is there in the horizon. That is digitalization. We think this is crucial to fill that hole that is going to be left behind from vehicle imports that we saw from last year. So the government has already taken a few initiatives, such as introducing the GovPay and as well as the digital motor insurance card. And we are also hearing that the national digital ID will come into play in the third quarter of this year. And all these things will help us to close down the loopholes and widen the tax net, which will help us to fill in that hole that is left from vehicle imports. Then we also have the expenditure slowly starting to pick up. So as I have highlighted here, this is the capex spending of the government. And from the research front, we are expecting 1 trillion rupees in terms of capex spending for 2026. Now, there's a question that a lot of people are going to pose here. The budget itself said capex spending for 1.3 trillion. Then the government again went to the parliament and got approved another 500 billion, raising up to 1.8 trillion. But we have predicted only 1 trillion here. The main reason is that although the government went to the parliament and got another 500 billion approved, we don't think that the government can spend this amount here. Mainly because of the fact that we are under IMF program, and in order to meet the primary surplus targets, the government has to stay within its boundaries. And that's why we think there's not a lot of room for capital spending. So what we are thinking right now is that government will focus on rebuilding the damaged infrastructure that were caused from DITWA, and may have to forego sometimes the new projects that will come on their way. So with revenue somewhat falling short, and with expenditure increasing, we are expecting budget deficit to slowly increase as well. So compared to last year, we are expecting for 2025 budget deficit will become around 4.1%. We are expecting this to increase to 5.9% in this year. And in the following year, we are expecting it to further increase 6.2 billion. So now let's look at the global front. So on the global front also, GDP is expected to slow down. And if you have been following the World Bank report that got released a couple of days ago, they're expecting GDP growth to be somewhere between 3.2% for the full year. And majority of the growth will be driven by the Asia-Pacific region, as you can see on the chart there. But most of the regions, such as Europe, is expected to have a very slow growth in 2026. So with this slow growth expectation, central banks around the world are taking a bit of aggressive steps where they are looking to cut down rates to propel their growth. And as you can what we have seen in the last year, where the Fed, they cut rates by twice last year by about 50 basis points, and now the rates are around the 4.25 to 4.5%. So discussing all of these, there's something that is lingering again in the global front. That is the rising political tensions in the world. So we have seen a few wars come up, and we have seen a few wars continuing. But we have seen a few wars getting halted as well. But these tensions are keeping slowly rising, and this is causing adverse pressure on the global GDP. So looking forward, before we move on to the next stage, where we are going to talk the recommendation, I want to put forward a few scenarios that we have shared with all of you a couple of years back. To be accurate, it's in August 2024, just before the elections. So at First Capital Research, we put forward these 4 scenarios. First scenario, the base case low scenario, the snail-paced stroll. The base case high scenario, that is the monorail dream. The super case scenario, the super grade highway. And the worst case scenario, the Sri Lankan pothole, where none of us want to be in that scenario. So out of these scenarios, we are thinking that Sri Lanka is progressing, and it's more, I think there's a chance that the first 2 scenarios is possible. So first 2 scenarios, the snail-paced stroll, we are having an outcome where GDP growth is between 3 to 4%. And interest rates can be on a possible rise, rising by about 100 to 250 basis points. Then debt to GDP is going to be a problem because of the slow growth, and GFN is expected to be underperformed. Then we have the scenario 2, which is the bit of an optimistic scenario, where we are thinking that GDP growth can be above 5% at least for the next few years. So in this scenario, we are thinking that interest rate will going to be stable, and the Sri Lanka is going to be outperforming both in terms of debt to GDP as well as gross financing need targets against the IMF. So analyzing these two scenarios further, we have put up a small chart where we are analyzing how the debt to GDP will be under these two scenarios. So the first scenario, the snail pace stroll, we think GDP growth is going to be between 3 to 4%. So that is why when you see the debt to GDP chart slowly rising in line with the slow growth. And if you can see on the dotted line, dotted charts, that is the IMF projection where we need to be by the end of the year. So as you can see, there is clearly a gap that we can't achieve if we are growing at 3 to 4%. But however, if we step up our growth and we try to achieve the 5% plus growth, which is the optimum case, then we see something very positive. That is, debt to GDP slowly coming down, and it's going to be below the IMF targets, which is going to be very positive for the country. So on the backdrop of this, and considering the two potential scenarios, we think from the current trajectory that the Sri Lanka is currently on, that the snail pace stroll or the base case low scenario is where the high probability lies, where we have given a 70% probability for this scenario. And the monorail dream is, that is the optimistic scenario, is beyond the 30%. Main reason why we are slightly tilting towards the base case low scenario is the lack of reform progress that we are seeing. And if we achieve the much needed reforms that we had to do in terms of the land, the entrepreneur, then in terms of trade, I'm sure that we can unlock the second scenario, which is the base case high scenario, where we are having a 5+ GDP going forward. Then, let me present the recommendations to you all. So first, on the recommendation on the bond market for 2026. So, for people who have been familiar with us, this is a system that we developed to assess the risk levels that is affecting the interest rates in the country. So here we have two set of criteria, the primary criteria as a secondary criteria, where primary criteria is having a bigger impact, while secondary criteria is having a slightly small impact. In terms of the primary criteria, we have foreign reserves, we have liquidity, we have private sector credit growth, we have foreign activity, and we have total credit. And in terms of secondary criteria, we have the rating changes, we have the rupee depreciation, we have the balance of trade and the balance of payment, and the business confidence. So all these factors combined and weighted, we are coming up with this fixed income health score. So as you can see, if you look at the period of between 2022, we see that a fixed income health score works because we saw interest rates going up when we hit the high risk territory. And with the economic recovery slowly, we have seen interest rates easing as well. And now something to mind is that we are seeing a bit of a change happening this year. That is, we are seeing the fixed income health score slowly dipping towards the medium low risk territory from 2025 December onwards. And I think we saw correctly that as well, with pressure coming and interest rates rising. So with that in mind, let's move forward. So before I move on to the fixed income recommendation where the yield curve is going to be, let me talk about policy rates. So in terms of policy rates, we are expecting policy rates to be broadly stable. Main reason why, we think that central bank may have to keep policy rates stable to reignite that growth that we are talking about. But there's also another thing that central bank can do, that is give a rate cut. So we are also not putting that out of the picture. We are giving a 30% probability that a rate cut can come our way. But broadly, we think policy rates are going to be stable. Although policy rates stay stable, we are expecting somewhat of a rise in the market interest rates, where, for instance, we are expecting market yield curve to rise up by between 50 to 100 basis points during the next 12 months. And if you can, from the screen here, you can see for December 2025, we are expecting the 1 year to be between 7.5 to 8.5, and this is expected to gradually rise to 8.5 to 9.5 by the end of this year. And on the 5-year bond, we are expecting December target was at 9.5 to 10.5. We have adjusted that slightly upward, and we are expecting 5-year bond to be between 10.5 to 11.5 by the end of this year. And in terms of the 10-year bond, it's a similar, we are having we are expecting a 100 basis point rise, where from the current 10 to 11%, we are expecting rise to 11 to 12%. So having discussed the bond view and the yield curve recommendation for 2026, let's move on to the banking rates or the AWPR. So as Akna correctly mentioned, we managed to correctly forecast where the AWPR is going to be broadly for the year of 2025. Now look at what's going to be happen in 2026. So in line with the pickup that we are going to have seen the market interest rates, we are thinking that the AWPR may see a rise as well, where AWPR is expected to be between 10 to 11% by end of December. In terms of exchange rate, last year we managed to predict correctly on the dot where the exchange rate is going to be. Exchange rate is going to be on the 310 level. So it broadly came in line. And for this year, we are expecting a similar view, where we are expecting somewhat of a 5% rupee depreciation in line with what we have seen in the past. So with that in mind, we are expecting the rupee to be between 320 to 330 by the end of this year. Then we have the last recommendation, that is the equity recommendation for 2026. To give you all the equity view, let me now invite my colleague Shahana to share the recommendation with you. So Shahana, over to you.
Thank you, Ranjan. Good evening, everyone. So as we look into the equity recommendations for 2026, the listed corporates are likely to record a 17% growth this year compared to the 25% growth recorded last year. So this moderation in earnings is attributed to a number of factors. Firstly, as Ranjan mentioned previously, the economy is likely to witness a moderation in growth this year. So this moderation in growth is likely to translate into lower business activity as well as lower factory utilization rates. Meanwhile, if we look at the business confidence index, the index dipped to a 12-month low in December 2025 and now indicates a subdued outlook. Along with that, we have seen the weakening currency that, together with the potential hike in electricity tariffs, is likely to impact business margins significantly. So overall, that is why we are looking at a moderation in terms of earnings growth. Moving on, we have seen the ASPI rising over 40% in 2025. Post-DITWA, we did see a slight dip in terms of the ASPI. However, it has since recovered and is now back at its 23,000 levels. So with that, the ASPI now trades in close proximity to its 18-year average PE of 12 times. However, looking at FCR's fair value estimates in terms of the ASPI, as you could see, we have taken a justified PE of 10 times, which is lower than the historical average of 12 times. The reason for this being the moderation in earnings that we are expecting, as well as the lower credit rating that Sri Lanka holds. So, keeping this in mind, this is what we are looking at, the final recommendation or our stance when it comes to equity. So we have advised our investors to cap equity allocations at 85% and maintain cash allocations at 15%. As the ASPI moves above the recommended range of 21,000 to 22,000, we are gradually requesting investors to reduce allocations or exposure towards equity. So with that, we come to the end of our presentation, and I would like to invite Ranjan back to the center stage. Thank you, Ranjan.
Thank you, Shana. So everyone, we have, as Shana mentioned, we have come to the end of the presentation. But before we wind down, let me highlight the quote that I started with. Austerity weakens growth, and weak growth increases the burden on debt. So we are right now at a crossroad right now. We are seeing a bit of a growth slowing down, and this is creating a bit of problems. We think the reforms is the way move forward. So with reforms getting forward, we think that it can reignite the growth that we are expecting to lose in the future. So hope we undertake that path and we progress on the reform front. And from with that, I'm sure we all can have a successful investment journey in 2026 as well. So thank you all, and thank you again.
Thank you very much, Ranjan, Shahana, and Akna, for that very insightful presentation. I have no doubt that the depth of information provided will, of course, be valuable to those in our attendance and those who are joining us virtually. And ladies and gentlemen, if you can shift your attention to the screen, please scan this QR code, as it will give you access to a PDF-ready version of the presentation that you can view and access at your convenience. With that being said, ladies and gentlemen, we are now moving to the panel discussion segment of this evening, where we hope to dive deeper into these themes with more depth and complexity. The panel discussion will start in a few short moments. Ladies and gentlemen, it is now time to introduce our distinguished panelists and moderator for today's panel discussion. Up first, we have our moderator for today's discussion, who is none other than our very own Deshani Ratnayaka, CFA, Vice President, Corporate Finance and Advisory at First Capital Advisory Services. Deshani has over 17 years of experience in banking and financial services. Her career began at Citibank in Colombo, where she held key roles, including Assistant Vice President for the Financial Institutions Group, managing both financial and non-banking financial institutions. Her expertise spans capital markets, risk and credit management, and compliance. She is a CFA charter holder and an associate member of the Chartered Institute of Management Accountants. Our first panelist is Mr. Gihad Kure, Deputy Chairperson and Group Finance Director of John Keells Holdings plc, who has overall responsibility of the group's finance and accounting, taxation, corporate finance and strategy, treasury, information technology, and corporate communications functions. He is a former chairman of Nations Trust Bank plc and holds an MBA from the Jesse H. Jones Graduate School of Management at Rice University, Houston, Texas. He is a fellow member of the Chartered Institute of Management Accountants in the UK, a certified management accountant of the Institute of Certified Management Accountants in Australia, and has a diploma in marketing from the Chartered Institute of Marketing, UK. He is also a committee member of the Ceylon Chamber of Commerce. Our next panelist is Ms. Sabrina Yusufali, who is the Managing Director of Hema's Consumer Brands and Hema's Holdings plc, driving growth and portfolio expansion across the home and personal care and learning sectors. She plays a key role in building and scaling homegrown brands across emerging categories, working closely with sales, marketing, innovation, and supply chain teams across Sri Lanka and Bangladesh. Sabrina is alumna of the University of Durham and Harvard Law School, combining strong brand building expertise with commercial leadership and frontier market insight. Joining us next is Mr. Nishal Ferdinando, Chief Executive Officer and Executive Director of JAT Holdings PLC. Nishal Ferdinando is a dynamic, results-oriented leader with over 15 years of experience as CEO and serving in the executive director level in fast-paced organizations. He joined JAT Holdings PLC as CEO in 2017 and was subsequently appointed to the board in 2021, having previously served as executive director at the Access Group of Companies. He led JAT Holdings IPO in 2021, expanded operations across Bangladesh, Kenya, Australia, and New Zealand, and diversified into the electric vehicle charging sector. Under his leadership, JAT Holdings has earned multiple national and international awards, including recognition amongst the top 100 most respected companies and a Fitch AA rating. He's an alumnus of Harvard Business School and holds an MBA from the University of Wales. Our final panelist, ladies and gentlemen, is Mr. Dimantha Matthew, Chief Research and Strategy Officer at First Capital Holdings PLC. Dimantha has over 17 years of experience within investment banking, with a predominant focus on research. Dimantha brings significant exposure in economic, fixed income, and equity research, portfolio management, debt and equity financing strategy, project finance, and corporate finance and advisory services. Prior to joining First Capital, Dimantha acted as head of research at SoftLogic Stockbrokers. He has also worked at Capital Alliance and John Keel Stockbrokers. He holds a Master of Business Administration from the University of Wales in the UK and a Bachelor of Laws from the University of London. He's an attorney at law in Sri Lanka and also holds FCMA and CGMA qualifications. Ladies and gentlemen, please join me once again in welcoming our panelists and moderator for today's panel discussion.
A very good evening to you all. It's great to see all of you here. Welcome to our discussion as we talk about investing with impact. As we sit here today, our country, Sri Lanka, is at a critical juncture. We've seen stabilization under the IMF, we've seen tentative growth, but we've also seen some challenges ahead of us. And obviously, Cyclone Ditwa has definitely taught us that things like social risks, climate risks are things that we really need to factor in to how we look at the investment climate. It cannot be something that we think of as residual risk, but really something that has to be in the forefront of how we plan, how we look at our investments, how we plan capital. And really today, that is what we are going to talk about. And the panel here before me today has been thoughtfully curated as we have brought together leaders that represent key sectors of our economy and sectors that we think will really shape on how we approach the market in the immediate future. Our speakers today span diversified conglomerates covering tourism and leisure, consumer and FMCG, industrial manufacturing and construction solutions, and capital markets. And so today our theme, Investing with Impact, although the theme was sort of crafted a few months ago, I think today, fast forward 6 months, it means a lot even as we come back out of the disaster and all of that. And so we're looking forward to an interesting conversation here today. Thank you for being here once again. Sabrina, I'm going to start with you. As we talk of, the pulse of the economy, let's start at the very beginning, as they say, household consumption. When you consider current consumer patterns, demands, affordability, preferences, and even value perception. What is your view? And I mean, when I say your view, I mean Hema's view in terms of outlook for growth over the next few years. And what segments, categories do you think this is really going to stem from?
So I think at a macro level, we're seeing the impact of stability and recovery on the consumer basket. So this is translating not just into growing consumer confidence, but we see the growth of volumes. And more importantly, we see consumers actually starting to choose brands again, starting to select based on quality. This is not to say that price isn't important and the discount segment doesn't exist. But for a period a year or two ago, we saw consumers trading out of the brands that they had grown up with into cheaper alternatives that were not giving them the same standard of quality. And that was a scary time for a branded CPG business, but we see that coming back. So I think that is telling us that the consumer is feeling stable and ready to sort of think value over price. So I think that at a large level, that seems to be the trend. But for us, as we look at the future, we are confident that growth is not going to come from pushing scale in highly penetrated categories. We are limited by our population size, and we are likely to continue to be limited by it over the next few years. So here, growth will really come from finding those pockets that correlate with demographic change. For instance, we see more women going to work, and that resulting in a whole bunch of categories coming up in things like sanitary napkins, in diapers, as they seek more convenient alternatives on the go. Gen Zs, for example, with their side gigs and side hustles are able to unlock a ton more disposable income than even baby boomers. And they are demanding brands that feel personal, that sell to them in channels that they frequent. And this won't be the traditional channels that we're used to servicing. So I think that's a really interesting opportunity. And lastly, the urbanization that we're seeing, where millennials are really coming to cities to work, are changing the notion of the family. And families are becoming smaller, that are becoming more nuclear. And this is changing consumption patterns, this is changing the shape of the basket. So for us, really, growth will come from finding the opportunities in the shift rather than pushing scale for scale's sake.
Encouraging note of recovery. Dihan, my next question is to you. Even as we talk of recovery, right, we've seen some refreshing positive developments on the leisure side, the tourism side. We've seen 2.36 million visitors in 2025, representing a 15% growth over 2024. And we are sitting in the midst of your iconic project, right? And even as we look at City of Dreams, how do you see Sri Lanka as we move beyond volume-based tourism into more sort of preferential, value-based offerings? How do you see city tourism, entertainment, integrated developments really?
Yeah, thanks for the question, and thank you for having me on the panel. Yeah, I think if you look at tourism in Sri Lanka, I think we all know the potential, but it's also, like you rightly said, it's a question of where we will see that demand and growth coming from. And if you look at city tourism in Sri Lanka, we really don't really compare with our peers. So if you look at Colombo as a city, we probably get maybe 25 to 30% of overall tourists visiting Colombo. Whereas if you look at other regional markets, that number is much higher. You take places like Thailand, the number of visitation or the number of people who will visit Thailand and go to Bangkok would be more than double of what we would get into Colombo. So it's also then a question of why would someone come into the city? And since you spoke of this project, I think when we envisioned Cinnamon Life at the time, or now City of Dreams, it was partly driven with that agenda as to how do you really drive tourism in the country, but also how do you catalyze tourism into the city. And that's how, if you look at the two main value propositions of this integrated resort, was about bringing in MICE, the conferencing, the corporate traveler coming into Colombo, firstly into Colombo, and then how do you get them into this property? So it's really selling first Colombo as a destination. And of course then gaming, which also sort of lends itself to how you really create a proper integrated resort. So with that, I think the vision was to see how we drive more visitation into the city and also grow the pie. So it's not that you're just trying to get a person who's already coming into Sri Lanka to visit the city, that may be part of it, but also bringing in people who may not have had Sri Lanka on the map. And that's exactly what the conferencing type of events are doing. Now it's still early days. We just opened this property just over a year ago. But I think we're seeing very good traction with the type of events that we're able to attract into Colombo. Not just our property, but some of the other properties as well. But given the multiple event spaces that we have here, so we have a couple of large conferences that we already had, two Indian corporates that had events late last year with around 1,000 delegates coming in. We have another large conference coming up in May with about 4,000 people coming in over a period of about 10 days. Now, Sri Lanka and Colombo would not have been able to attract these sort of numbers if not for having the facilities. So I think that is really an opportunity for overall tourism growth. If you look at it, we are, as you all know, we are a small island, only so much of kilometers or hundreds of kilometers of beaches, a lot of very unique spaces and places, but they still have capacity. Whereas a city doesn't necessarily have capacity as long as you have enough activity in the city. So I think it's a combination of not just Colombo-based tourism, overall tourism growth, but if you look at over the last few years, particularly post-pandemic and post the financial crisis, we saw a significant increase in the number of rooms in the city, which now you're seeing that get absorbed. And that's obviously, that augurs well for overall sort of rates in the city as well. But what it also means, the flip side of that is we have still enough rooms to be able to drive more tourism numbers into Sri Lanka and Colombo.
Okay. And definitely a positive impact for us in terms of employment and the labor market, all of that.
Absolutely.
Yeah. Nisha, over to you, looking at the construction side. Right? Over the last year or so, we've seen significant improvement in the construction sector. The construction PMI itself has expanded. If you look at Jan 25 to December, the numbers itself speak for itself. Sorry, November. 52 to 66 odd, right? And also with the government increasing its budgetary allocations for construction, the sector, as people say, is expected to maintain momentum and remain a growth area. I think all eyes are on the construction side. Not to mention Cyclone Ditwa also calling for a lot more post-disaster work. So from a macro standpoint, how important is this sector in ensuring that recovery spending translates into more durable economic value and not, a short-term stimulus of sorts? What are your views on this?
Good evening, and thank you for having me on the panel. If you focus on the cyclone itself, I think 4.1 billion is the estimated infrastructure and building damage. Out of this, 80% is purely on residential and industrial, and also the main infrastructure, where 20% is on the agriculture sector. So 80% of 4.1 billion is about 3.2 billion worth of work that needs to happen in the near future. And this is 0.48% of the entire capital stock of buildings and infrastructure in the entire country. Right? So I think this surge that will come, I think it gives an opportunity for us to build back better. Right? Not just build for the sake of building or to expedite it, but we understand that building back better would actually add value to the economy. And when we do this, I think resilient designs is something that we have to focus on. So along with the government, I think the construction sector and the building material sector can come together and propose these resilient designs. Right? We could propose more durable material or more futuristic material at this moment. So I see that as a great opportunity, not only to, boost construction income, but that build back better is something I think which we all have to be mindful of. And while we do this, so there is going to be a demand because of the cyclone, which will spike at different times. Say, for example, if you take the paint industry, if you take Colombo district and Kandy district, right? So Colombo compared to Kandy, the disaster was lesser in terms of structures. But Kandy, the total disaster from structure level is quite high. So the paint demand in Colombo will spike up maybe in another 2 months' time, and Kandy will spike up or Central Province will spike up in about 6 months' time. So I think predicting this, and also the construction and the building material companies having adequate stocks, inventory, would be essential in order to cater to this demand. Because otherwise what happens is, if we fall short, we would have to air freight or give alternative materials which are not the best suitable, and it also can delay the projects. I think another aspect is the labor part of it, because upskilling and having your labor demand during this time is going to be critical. And if it slows down the projects again, it's a huge opportunity cost for the country. And finally, I feel when disaster strikes, there's always a silver line. And I think the construction industry can be future ready if we become more efficient, if we think out of the box, if we introduce new technologies at this moment. I think the construction and the building sector or building material sector industries in this country can be future ready and can be equipped thereafter to build capacity, and thereafter excess capacity can be maybe taken overseas. So overall, I think this construction industry would play a pivotal role in this, and it has to play a responsible role as well.
That's right. That's right. And also, I think build back better is something we can definitely take away, because the disasters just keep happening. I mean, every year we are, sort of caught by the floods and all of that. I mean, this year the cyclone hit on a different scale, but it's definitely something we need to think about. Dimantha, while we are on this trend of recovery, we've seen Sri Lanka's recovery remain anchored to the IMF program with tight fiscal constraints and a strong focus on debt sustainability. With the aftermath of the cyclone, reconstruction needs have also emerged as a priority. From a macro perspective, how do you see the balance evolving between fiscal consolidation, disaster expenditure, and also growth imperatives over the next 12 to 24 months? I mean, there are lots of things we need to juggle. So in terms of that, what's your view?
Yes, Deshani, so that's exactly it, the balancing growth and what needs to be done is something important. So let me take you through what we were saying in the report as well. Now, there must be a bit of a confusion also at some point, where on one side we're looking at GDP growth somewhat slowing down. Obviously, we've seen slight increase in rates already. And with that, there could be some amount of slowness in growth. But then on the other side, we are also advocating that there is a possibility that rates also may move up. And so how does that happen? What kind of risk comes in here? So the problem here is it's the debt sustainability risk. So you can't really afford to grow too slow as well. So as we explained now, your growth slows down to around 3 to 4%. You're not generating sufficient growth or nominal growth in terms of GDP to push down the debt to GDP levels. And then this year there's another problem. We are not going to have that amount of trade surplus that we had last year. We had the luxury of a large trade surplus where we managed to accumulate a lot of dollars during especially the first half of the year. So and which was used to pay some of the debt as well. So now that luxury is unlikely to be there during this year. So with that, there seems to be some amount, a requirement to accumulate reserves as well somehow. So you're having a currency depreciation also coming in. So how is the risk here? So on one side, what we need to do as Sri Lanka is to improve its solvency level. So increasing reserves, bringing down debt to GDP is part of it. Now, if this is not happening, at some point of time, you're going to start attaching some amount of a premium into the economy. So that's what's happening with the interest rate. So you're likely to have slower growth is likely to lead to a bit more higher interest rate, which is coming off higher risk to the economy. So balancing that is a key aspect of government. I think the reform agenda may play a key role in doing this, where it can help improve some of these growth factors by bringing in FDI, growing through that. So involving the private sector for growth.
Thank you, Dimantha. Gihan, my next question is to you, and we definitely cannot let you go without talking about this subject, something close to home, the EV market, right? And EVs and JKH's experience with that. We've seen how pent-up demand has now sort of staggered, but also increased. The 2025, we saw a sudden surge of vehicles coming in. And with that, market share of EVs is now 10%, I believe, of the market, so which is significant, right? Drawing from your experience, and some of them bittersweet, might I add, what are some of the key takeaways you can share with us in terms of what's working, what's not, what do we need to do in certain areas?
Yeah, well, thanks for that question. I think in terms of the EV market or industry itself, I think it's very clear of the value proposition that's there from a country point of view, from a individual's point of view. And that's where you're really seeing how EVs have really picked up and how even our own sales have really picked up. If you look at the new vehicle segment, the share of EVs is quite significant in such a short span of time. Now, that has a significant benefit from a country perspective. We've spoken of the economy, we've spoken of deficits. If you look at it in terms of transportation and the type of fuel bill that you spend on the transportation component for even private vehicular traffic, there's a significant benefit. So I think from a country agenda point of view, I think it's something we've naturally been promoting. But I think it's from an overall policy perspective also where the government really needs to also look at it in terms of the benefit to the economy, in terms of really promoting EVs, because it has a long-term impact. We talk of climate resilience and all that, and it's something to really look at. If you look at renewables and the household investment in solar energy, you can see the impact it has had on the grid, the positive impact. Of course, I'm no expert on that, but in terms of balancing off the grid, it's almost like a good problem to have when you are generating that type of solar and the renewable energy contribution to the overall grid. Now, if you sort of keep driving that investment on the one side, and on the other hand, you have higher vehicle ownership of EVs, then you're really looking at having much cleaner transport and more sustainable mobility. There's also a debate and a school of thought that if one has an EV and you're using the grid and using fossil fuel or thermal power to sort of charge your vehicle, that then it may not really add up in terms of the economics. And we've studied that impact, And whilst it's obviously cleaner and cheaper if you're generating it and charging through renewables, still, if you look at charging it through thermal generated power or whatever it is, if you look at the efficiency of the EVs versus a normal combustion engine, it is still cheaper from a vehicle owner's perspective and even from a sort of emissions perspective. So I think obviously we are promoting this because we have a range of EVs or hybrids, but I think there is a sort of national agenda as well. And like I said, from an individual's perspective, that's something that there's a clear value proposition. When we started this business, before we, the imports, the markets opened out, we were very conscious of addressing some of the concerns that one would have. Obviously, in terms of BYD and a Chinese brand, we had to establish that, though it's, the #1 EV market in the world, unknown in Sri Lanka. But also what you call range anxiety, how does one get over that mindset of the charging network, the ecosystem? So we try to leverage off the sort of network that we have with our supermarket outlets, even the hotels and so on. So that's expanding, and of course partnered with others who are also driving that sort of network. We could sort of then jointly ensure that that network develops. If you really look at it, I mean, Sri Lanka is a small place. So when you have a range of 400 kilometers, unless you're really doing a road trip, it's just the mindset on confidence that you need in a sense. But still, having said that, we need to ensure that we develop that ecosystem so that everyone has that comfort. You touched on some of the challenges, and we've been trying to overcome those challenges. And right now, we've managed to overcome the challenges in terms of ensuring that all the vehicles that we had that were stuck without being released have now been released. But we are still looking for a more permanent, sustainable solution. But fortunately, BYD has such a wide range of products from entry level to the hybrid ranges and so on. So in terms of the portfolio, we still have enough to offer our customers, though we would like to be able to offer the full and wider range, which right now we are unable to. But I think whilst pent-up demand will settle next year, we still believe that momentum, and particularly for EVs, can continue or sustain.
Thank you. Sabrina, while we're on this topic of sustainability, I think being a consumer company too, you have your fair share of trade-offs to sort of look into with sustainability in terms of packaging, managing your margins, and also ensuring returns. So how do players such as yourselves embed ESG into your core strategy and look at it more from a long-term holistic view as opposed to, just sort of ticking the box? And is this really something you see value in long-term? What are your thoughts?
Yeah, for me, I'm not really a fan of framing impact as CSR, because I think that that's often the first thing that gets cut when a company is in trouble. I think that today, as competition increases, as margin pressure increases, and as consumer demand is changing super fast, companies have to ensure that they are earning their customers. And what I mean by that is typically they have to demonstrate that they're solving a real customer problem at a price point they can afford, and then live to tell the tale. So, and this often, this goes beyond making a product or a service. This comes from essentially making impact part of the business model. And we find that, in segments, particularly, sanitary napkins is a good example. 1 in 3 menstruating women today use a sanitary napkin, and we found that, going into schools, going into offices, educating women about the need to use this product actually helped to grow the market and move the needle on what I think is a social problem. So for me, purpose and profit can very easily coexist, and it should coexist. I think that's the one way it can be sustainable.
Definitely, I think long-term resilience, like you said, is not just about the short term, but really making it a holistic thing, right? Like if you need process, you need product, and everyone to really fall in line. And we are not just looking at domestic demand when we talk about sustainability and long-term resilience, but also global competitiveness and the importance of really taking Sri Lanka and Sri Lankan brands out into the world. And on that note, Nishal, to you. Recently, we saw Jet moving into New Zealand with the acquisition of Miratone, and congratulations on that, might I add. And in terms of, taking the construction materials out there, what are your views? Are we competitive? Do we have an edge? Is there demand for Sri Lankan products in this sector? We'd like to hear.
Yeah, so I think going international, I think there's two categories, being in emerging markets and in developed markets. So that has already been in Bangladesh, Maldives, Kenya, and that experience was a different experience because those I consider as emerging markets. But New Zealand, and we are about to launch maybe in the next 6 months in Australia, that poses a different sort of challenge because it's a developed country, and also maybe the way we operate is different. But I think something that, it's a very simple thing, but something that struck me is we need to have self-confidence. As a Sri Lankan company moving into a developed country and operating in those economies, we are not exporting from here. We are actually manufacturing in New Zealand and we are operating in that economy. So it takes a lot of self-confidence, not because it's not an individual, it's a company or its employees, which translates to a culture. And so fortunately, that in Sri Lanka, we compete with paint companies that are world's number 3, number 4, and number 7, right? So we have been for the last 15 years competing with these 3 players who are global giants, and we have been maintaining our market share, and in terms of quality, in terms of innovation, we have been matching this, right? So, and we don't have a home advantage as well because those multinationals manufacture, all 3 of them manufacture in Sri Lanka. So this actually, as a company, has given us that confidence that we can compete with the world. And I think when we moved to New Zealand and shortly in Australia, something that we found out was in terms of compliance, innovation and quality, yes, we can compete. Right? It is just that some of the competitors there, their pockets are much more steeper. So we need to then find something like maybe a niche market, maybe focus products, or maybe collaborations. Say, for example, our R&D collaborates with Cal Poly, that is the California Polytech University, and the Polytech in Spain universities. So through collaboration, also sometimes we can compete, and we can actually, from a capital point of view, the lack that we have, we could, if we think out of the box and be innovative. Another factor is the introduction of technology, AI, and all of that can be used. Say, for example, some of these multinational companies have 1,200 R&D specialists, right, globally. That has 20 R&D specialists. Now, in that scale, you can get intimidated by the number. But if you look at AI and if you implement it properly, your product development life cycle over a period of 2 years can be cut down by 1/3. Right? So introducing the proper technologies at the correct time, and also being focused. Say, when someone else has 1,200 R&D specialists, and they have, we'll say, 1,000 products, we focus on 20 products, but we do that well. And we do it in a world-class manner. So I feel once you start competing and you actually maybe get some wins, easy wins sometimes, and then I think you can grow. So Miratone is New Zealand's #1 in terms of wood coating. It was formerly Australia's #1 wood coating as well. So even in terms of resources, what we feel is From a management point of view, yes, Sri Lankans can match the management capabilities of developed countries. From R&D point of view, on a one-to-one basis, yes, we can match it, right? So I think it's just about self-belief and going out there and sticking to your core competencies. And I think a lot of companies can do that, but it's a simple word, self-belief.
And finding the right partnerships.
Exactly.
Before we break into our last couple of questions, just want to know if there are any questions out there from the audience. If you'd like to pose that now, or maybe we can give you a few more minutes. I believe there'll be mics passed around. Okay, maybe not right now, but we definitely will have the chance in a few more minutes. Gihan, to you. The West Container Terminal, right? You all began operations last year, April, sorry. And it has been performing fairly well in relation to your peers. How do you sort of envision its role going forward and supporting national ambition of, Sri Lanka being a regional maritime hub? And how do you see JKH positioning yourselves in this space?
The WCT has been really a success story in terms of how soon it's ramped up. As we always knew, Colombo was badly in need of deep water capacity. So the project ideally should have happened maybe, a few years even before. So what it's sort of showcased is really the demand dynamics that exist. Sri Lanka is, as we know, perfectly placed. We have that geographical advantage. And it's really just leveraging or capitalizing off that. We do maybe 85% transshipment volumes. 70% of that is in and out of India. And with the type of growth and the future outlook even for India, we are essentially then just playing off that an extension of an Indian port and capitalizing on that opportunity. And that's exactly what the West Container Terminal has done by bringing in deep water capacity. So if you look at it, how soon it's ramped up, which is sort of really ahead of expectations in a sense, in that it has about 1.6 million TEU capacity in phase 1. And at the sort of run rate that it's going at now, we are sort of pretty much at 90% utilization of that capacity already. And Deshani, as you said, we started operations only in April. Phase 2 is now being rolled out. And by end of this year, calendar year, we will have the balance 1.6 million TEUs fully operational. And we are hopeful that this sort of momentum will continue. I think from an overall Sri Lanka economy point of view, transportation and logistics is and will continue to be one of the drivers of growth. And I think that's where the government can look to drive that even further. Because if you look at it, the East Container Terminal has not still become fully operational, and that is an opportunity to even get investment in if they really want to go through that route. Global shipping lines see Sri Lanka very much as a transportation hub, and we can leverage off that even further. We can look at more value-added roles as well in Colombo, so not just the transshipment, but looking at more integrated logistics, which sort of creates a better ecosystem and a more sort of stickier ecosystem than just doing transshipment. So there's a lot more that can be also done, but the outlook for the Port of Colombo is looking very positive, and hopefully this sort of growth will sustain with phase 2 capacity coming in on stream as well.
Thank you. That's definitely very encouraging. Just sort of wrapping up, as we wrap up this panel discussion, I don't think we can leave this subject untouched. And my question is to Dimantha. On the geopolitical tensions and impact of that, and how that's really looking to us. I mean, we've seen the up and down and the back and forth from the Middle East to Latin America. How do you see these events impacting us, and in what sort of ways will these translate into our market and economy?
Yeah. So that's an interesting question, because now some may think that Sri Lanka is not really that well connected and probably not in the global value chain like the kinds of India or Vietnam and so on. But there still is a sizable impact coming in. Simply because on one side you're dependent on significantly on oil, right? So the price of oil has a significant impact for your economy, because it's a big portion of your import bill. And then on the other side, two of your key exports, apparel and tea. So apparel having, now we've seen that the global growth is expected to somewhat slow down because of these tensions. So that will invariably have impact on our apparel, which is about 30% of exports. So bulk of it going to US and Europe is going to have a significant impact. Then you have tea being exported a large quantity to Middle East. So tensions are going to have a significant impact. We also what kind of impact it did when US put in tariffs into Sri Lanka. So basically, I think it's a key element, and obviously global tensions are at a high level, and it's going to have somewhat of a adverse impact if it's going to lead to slower growth rates, so which will have significant impact to Sri Lanka, because a key element is that our exports are not diversified, and also the fact that bulk of it is going into developed countries and not really into the high growth countries that are there at the moment. So that is a key element. So I think part of the risk that we are facing in the economy is also because of that. We can shift our focus and move towards the other areas in the world that could have a significantly better outcome.
Thank you. And with that, we'd like to open the floor for questions. This is your chance. Would anyone have? Yeah, we have a question here. If someone can please, might need to keep your hand raised.
Hello. Thank you so much for the wonderful research. Just want to understand a few points. One being, I think if you look at the research that was just presented before, at a very high level, it sounds like we're on track for somewhat of a subdued GDP growth, inflation kicking up and currency weakening. And this question is for anyone on the panel, considering that the bulk of your respective businesses cater to the local market. It sounds like the total kind of consumer spending will be challenged if all of those factors align. As a business, does that worry you, considering that your customer base, the bulk of it are very consumer driven, be it in retail, brands, or construction?
Thanks for that question. I think a business has a choice to either be defined by the GDP growth or to find a way out of it. So for us, how we think about it is that if consumption growth is slowing, what other opportunities are emerging? And as I said, what we're seeing is actually a growth in things like the premium segment of the market. So volumes may slow, but we feel that value growth may still be on the table. And the other thing is, particularly for our business, we are not in a leadership position in the context of a market, so there's market share gain as well to innovate into. So that's how we look at it.
We have time for the next question. You might have to raise your hand a little higher because it's a little dark at the back. Okay, I believe we don't have any questions. But as we close, I'd like to pose a question to sort of wrap up your final thoughts on where we are. And if we look at investing with impact, which is what we've been talking about, as capital that generates returns while strengthening economic resilience, be it climate, social, financial, I mean, that impacts us all. What is one shift you believe that we as a nation need to make in terms of how capital is allocated, in terms of regulation, and even just sort of, in terms of incentivizing the market over the next few years? What are some final thoughts you may have as we quickly go down the line? I'd like to start with you, Gihan, maybe.
I think a couple of aspects that need to be looked at. I think one is, as we saw with the recent the cyclone Ditwa, is the sort of physical infrastructure. And when you look at your business, how do you look at managing that? So if you look at our hotels in the Maldives or in Sri Lanka or other assets, how do you look at sort of ensuring that, as Nisha spoke earlier, building with more resilience, ensuring that you withstand some of these impacts to the extent that you can. The other aspect, of course, is looking at your value chains and how you build resilience into your value chains, whether it's sort of your supplier base or your agri inputs and so on, and look at more sort of climate resilient crops, depending on the type of industry you're in. And of course, then from a portfolio allocation perspective as well, I think how one looks at allocating capital and looking at, how one computes returns, because sometimes as much as you might look at, normal hurdle rate of whatever it is on a financial investment, when you look at these type of investments, the pure computation may not meet that hurdle rate, but then how do you factor in those scenarios? And if you look at it from that medium to long-term perspective, and factor that in, then really the opportunity cost of that may actually meet your hurdle rate. So I think it's that mindset of how you look at things from that perspective.
Thank you. Sabrina?
Yeah, for me, I think taking a longer term portfolio allocation along where growth is likely to come from in the next 5 to 10 years. So two things. One is, as I said earlier, I think growth will come from driving in our categories at least, driving household penetration in under-penetrated categories. So whether it's across healthcare or consumer, that's our focus. And the second is building markets outside Sri Lanka, particularly in frontier markets. So that's how we're thinking about capital allocation.
So I think I resonate with both what Gihan and Sabrina said. And so I think, but the focus really has to be in allocating capital, maybe the transparency and all of that, in making industries eventually that can compete with the world. Because look, what you're saying, Sri Lanka is a 21 million population, right? And the only way that cooperates, or from a macro point of view even, is that if we step out there, right? And I mean, all these shocks that we have had, right, throughout, I think Sri Lanka can never catch a break, right? But all of this has built a lot of resilience. But I think with all of this, we need to really focus how we could be world class. And if that, even from a government point of view, if if they allocate funds for exporters, or even if they sort of give incentives, right, for companies to be better, even from a R&D point of view, right, even from a technology point of view. I think all of this would shape, I mean, not even companies, but industries to compete with the world. I think that would be my final thoughts on that.
Definitely, I would agree with that too. Dimanta?
Yeah, so let me give a piece of advice for the investors or what to sort of look out for. I think what everybody needs to look out for is what's in store in the reform agenda and what are getting implemented at what point of time. So we've achieved a level of stability, and that has been through some aggressive fiscal consolidation and some of the stern decisions that has been taken. Now, I think it's time to be a bit more aggressive on the reform side of things. It could be in the form of SOE reform. It could be in the form of tariffs reform. So those are the things that as investors you should be eyeing in, because these are things that can be implemented over a few months of time. And then we are also looking at digitalizing, introducing the digital ID that could have a significant impact. So these kind of reforms are the ones that are needed. Obviously, we are in delay, and also it's laid out in the IMF. Some of these are laid out in the IMF program. So are we aggressive enough? Do we have the guts to implement what's there and change the course of the economy? Or are we going to go on a slow path? So that's the decision that has to be taken. So let's watch out and see.
Thank you, Dimanta. And thank you so much to you all, Gihan, Sabrina, Nishal, and Dimanta, for your time and views on the topics we discussed today. It's definitely some very encouraging thoughts here today. I'm sure you all agree. Some great strides made in terms of recovery, but also work to be done. And I think that's where we all need to join hands together. And, we can't do this alone. And so with that, we'd like to draw this panel discussion to a close. Thank you for being a wonderful audience. And I'd like to hand over the mics to our MC for the night.
Ladies and gentlemen, as we come to the close of today's program, I would like to take a moment to extend our sincere gratitude to our panelists and our moderator for sharing their valuable insights with us. But of course, we would like to present a token of our appreciation to each of our panelists in recognition for their time, expertise, and valuable contribution to today's panel discussion. To do the honors, I would like to invite Mr. Dilshan Veerasekara, Managing Director, CEO of First Capital Holdings, PLC. Thank you very much once again to our panelists. Ladies and gentlemen, please take a moment to scan the QR code that you see displayed on screen. We kindly request you to take a moment to please share your feedback with us regarding the event, as we are committed to the philosophy of constantly refining our efforts. And of course, we can't quite bring the day to a close without taking a moment to thank you, our audience, for your support, for your presence, and of course, your active participation. Which is why I'd like to take a moment to extend a very warm invitation for all of you to join us for some networking and fellowship over some cocktails, which will begin momentarily. Once again, ladies and gentlemen, thank you very much for being here with us this evening, and eventually have a safe journey home. Thank you.